5 years ago, the idea of putting money into something invisible seemed absurd. The word cryptocurrency was just another tech buzzword floating around the internet, something for computer geeks and risk takers. But that skepticism slowly turned into curiosity, and curiosity eventually transformed into a decision that would completely reshape financial stability and freedom. The early days of doubt, like many people, the introduction to cryptocurrency came through casual conversations and online articles. Friends would mention Bitcoin over coffee, coworkers would share stories about someone who made thousands overnight, and social media was flooded with success stories that seemed too good to be true. The initial reaction was predictable. This must be another internet fad, something that would disappear as quickly as it arrived. But the more research that happened, the clearer it became that digital currencies represented something bigger than quick profits. Blockchain technology, the foundation of cryptocurrency, offered a decentralized financial system that operated without banks or government control. Transactions could happen across borders in minutes rather than days, and the fees were a fraction of what traditional banks charged. The concept was revolutionary, even if the risks were undeniable. The turning point came in early 2002, with a modest savings account earning almost nothing in interest and inflation slowly eating away at purchasing power. The traditional approach to saving money felt increasingly pointless. The pandemic had disrupted global economies, and central banks were printing money at unprecedented rates. It became clear that holding cash was no longer a safe strategy for preserving wealth. Taking the first step, starting small, was the only sensible approach. The first investment was just $200 in Bitcoin, an amount that wouldn't cause financial disaster if it disappeared completely. The process felt intimidating at first, setting up a digital wallet, understanding private keys, and navigating cryptocurrency exchanges. But within a few weeks, those initial hurdles became routine. What happened next was unexpected. That $200 investment grew to $300 in just a few months. Not life-changing money, but enough to prove that there was real potential here. More importantly, it sparked a genuine interest in understanding how these markets worked, what drove prices up and down, and how blockchain technology was evolving beyond simple currency transfers. The learning curve was steep. Hours were spent reading white papers, watching educational videos, and following market analysis from credible sources. Ethereum became particularly interesting because of its smart contract capabilities, which allowed developers to build decentralized applications on top of the blockchain. This wasn't just digital money anymore. It was an entire ecosystem of financial tools that operated without intermediaries. Building a strategy, the biggest mistake many people make with cryptocurrency, is treating it like gambling. They buy during price surges, panic sell during crashes, and chase every new coin that promises overnight returns. Avoiding this trap required a disciplined approach based on research and long-term thinking. A simple strategy emerged. Invest a fixed amount every month regardless of price fluctuations, diversify across multiple established cryptocurrencies, and never invest more than could be afforded to lose. This method, known as dollar cost averaging, helped smooth out the extreme volatility that defines crypto markets. When prices dropped, that monthly investment bought more coins. When prices rose, the portfolio value increased. Diversification became crucial. While Bitcoin remained the largest holding due to its established track record and widespread adoption, Ethereum offered exposure to the growing world of decentralized finance. Smaller positions in other projects provided additional diversification, though these were approached with extra caution since newer cryptocurrencies carry significantly higher risks. The real benefits, beyond price gains, the most obvious benefit was the portfolio growth. What started as small monthly contributions gradually built into a substantial asset that outpaced traditional savings by a considerable margin. During bull markets, the gains were impressive. During bear markets, the strategy of consistent buying meant accumulating more coins at lower prices. But the financial transformation went deeper than just watching numbers go up. Cryptocurrency provided access to financial tools that traditional banks simply don't offer. Staking allowed certain cryptocurrencies to earn passive rewards, similar to interest but often at much higher rates. Lending platforms enabled earning additional income by providing liquidity to decentralized markets. The real shift in mindset came from understanding that money itself was evolving. For decades, financial systems operated with banks as mandatory middlemen, taking fees for every transaction and controlling who could access services. Cryptocurrency offered an alternative, a global financial system that anyone with internet access could use regardless of location, credit history, or banking relationships. This was particularly eye-opening when sending money internationally. Traditional wire transfers could take days and cost significant fees. With cryptocurrency, transfers happened in minutes and cost a fraction of the price. The practical applications became clear. This technology solved real problems that legacy financial systems created. Navigating the challenges, honesty requires acknowledging the difficulties. Cryptocurrency volatility is not for the faint of heart. There were months when portfolio values dropped by 30 or 40%, moments when selling everything felt like the rational choice. The key was maintaining perspective and remembering the long-term strategy. Security concerns required constant vigilance. Unlike bank accounts with fraud protection and insurance, cryptocurrency puts full responsibility on the owner. Losing access to a wallet or falling victim to a scam means permanent loss with no recourse. This meant investing in hardware wallets for secure storage, enabling two-factor authentication on all accounts, and never sharing private keys or seed phrases with anyone. The regulatory uncertainty added another layer of complexity. Tax implications varied by country, and keeping accurate records of every transaction became essential. Rules changed frequently as governments tried to figure out how to handle this new asset class. Staying informed and compliant required ongoing effort. The current reality, 5 years into this journey, cryptocurrency has fundamentally altered the financial landscape. What began as an experiment with a few $100s has grown into a significant portion of overall wealth. More importantly, it provided financial education that traditional schooling never offered. Understanding market cycles, managing risk, thinking long-term, and taking responsibility for financial decisions. The passive income generated through staking and lending now provides meaningful additional cash flow each month. This money gets reinvested, creating a compounding effect that accelerates growth over time. The portfolio weathered multiple major market crashes and emerged stronger, proving that a patient, disciplined approach works even in volatile markets. Cryptocurrency didn't make anyone a millionaire overnight, and anyone promising that result is either lying or lucky. What it did provide was a path to genuine financial improvement through disciplined investing, continuous learning, and calculated risk-taking. The technology continues evolving, with new applications emerging regularly that extend beyond simple currency into areas like digital identity, supply chain management, and decentralized organizations. The honest assessment is this: cryptocurrency carries real risks, including extreme volatility, security threats, and regulatory uncertainty. It should never represent money needed for essential expenses or emergency funds. But for those willing to educate themselves, invest responsibly, and maintain patience through market cycles, it offers opportunities that traditional financial systems simply cannot match. The transformation wasn't about getting rich quick. It was about taking control of financial destiny, learning how modern digital finance works, and building wealth through consistent action over time. 5 years later, the only regret is not starting sooner, though starting with caution and education made all the difference between success and becoming another cautionary tale.